Welcome back to the channel, finance fans. Today, we break down a macroeconomic mystery that hits close to home. Meet Jordan. Jordan is shopping for a new home, trying to lock in a low mortgage rate, but out of nowhere, his local bank hands him a shockingly high interest rate quote. Why? Well, a massive trade policy shift overseas completely derailed his plans. You're told that tariffs protect local businesses from foreign competitors. But what the news rarely explains is that a trade dispute thousands of miles away can quietly add hundreds of dollars to your monthly mortgage payment.
To understand this connection, we must visit a massive global auction house where the United States government raises cash. See, the government constantly spends more money than it collects in taxes, filling that gap by issuing government IOU notes, known as Treasury bonds. Anyone can buy these bonds, but the ultra-wealthy VIP buyers in the front row are foreign countries like Japan and China. They bring trillions of dollars to this auction, greedily snapping up American debt because it is considered the safest investment on Earth. Jordan is watching from the back row as the auctioneer continuously shouts out numbers, hammering down trillions in bonds to these international superpowers. This continuous flow of foreign cash keeps the auction running smoothly, ensuring the government stays well-funded while keeping domestic interest rates stable for everyday borrowers like Jordan. Everything changed during April and May of 2025 when a sudden shift in U.S. tariff policy sent shockwaves through the global financial system. The United States announced aggressive new trade barriers, slapping heavy taxes on imported goods from major trading partners. Naturally, those front-row VIP buyers at our global credit auction were not happy about getting hit with billions in brand-new penalties. In retaliation, these massive foreign treasury holders dropped a financial bombshell. They threatened to completely pull back their regular bond purchases. Imagine those wealthy bidders crossing their arms, glaring at the auctioneer, and lowering their bidding paddles in unison. They signaled to the world that if their goods were going to be taxed at the border, they would stop lending their trillions to the American government, creating an immediate, terrifying void in the financial market. This sudden drop in demand triggered a fundamental rule of economics: the inverse relationship between bond prices and bond yields. With the major foreign superpowers sitting on their hands, the auction room felt empty, leaving a mountain of unsold government debt. To attract new, reluctant buyers to step up to the plate, the U.S. government had to sweeten the deal significantly. Since they cannot change the face value of the bonds, they are forced to offer a much higher interest payout, known as the bond yield. Think of it like a desperate shopkeeper putting a massive sale sign out front, screaming that they will pay higher returns to anyone willing to buy their debt. Jordan watches in awe as the yield percentage chart aggressively spikes upward in bright crimson, driven entirely by the sudden absence of international buyers. Now, you might wonder why Jordan should care about global bond yields spiking at a government auction. Here is the direct link to Main Street. Domestic banks use the 10-year U.S. Treasury bond yield as the foundational benchmark for pricing consumer loans. When the government pays higher interest rates to its international lenders, every single commercial bank immediately raises their own rates to match. Suddenly, the interest rate on a 30-year fixed mortgage climbs rapidly alongside those spiking Treasury yields. The bank passes this exact macroeconomic penalty directly down to Jordan. The affordable house he fell in love with weeks ago is suddenly out of reach, not because the seller raised the price, but because the monthly interest payment expanded by hundreds of dollars. This is the hidden, painful price of global economic warfare. So, let's trace our complete cause and effect whiteboard chain one final time to lock it in. It all starts with an aggressive international tariff policy shift. That tariff causes vital foreign buyers to pull back their capital from the ongoing U.S. Treasury debt auctions. With fewer buyers in the room, the government must dramatically spike bond yields to attract new investors. Finally, those rising yields force commercial banks to lift domestic mortgage rates, hitting regular homebuyers like Jordan directly in the wallet. The next time you hear politicians debating complex trade policies or border taxes on the news, remember that global finance is deeply interconnected. Tariffs are never just isolated economic theories. They are real-world forces that directly dictate the cost of your future home. Stay informed, track the global auctions, and protect your financial health.
As always, appreciate you hanging out today. See you in the next one.